Welcome to The Explainer. Today we're diving into something that literally sounds like magic, the holy grail of trading, risk-free profit. You know, in financial markets, every single move usually comes with some strings attached, right? The idea of making money without taking any chances just feels like a total illusion. But, as we're going to see today, it's actually a very real fundamental engine that keeps our global markets humming.
So, I want you to really think about this for a second. What if you could guarantee a risk-free profit? Honestly, to most of us, free money sounds like a massive scam, doesn't it? But when you get into the weeds of the professional financial world, especially around derivative pricing and market efficiency, there's a mathematical mechanism built to do exactly that. No tricks, no gimmicks, just pure strategy.
And that strategy, it's called arbitrage. Basically, it's earning a risk-free profit from price differences by simultaneously buying undervalued assets and selling overvalued ones. Now, the absolute crucial point here, the secret sauce, is that word right there, simultaneously. You're not buying a stock today and crossing your fingers it goes up next week. No, you are buying and selling at the exact same millisecond to lock in that price difference. Market goes up, market goes down, doesn't matter.
So, here's our quick roadmap for this explainer. 1. What is arbitrage? 2. Cash, carry, and currency. 3. The high-frequency giants. 4. What stops the trade? And finally, number 5, cracking the CFA exam. Let's get into it.
All right, kicking things off with Section 1. What is arbitrage? The basics. Because before we tackle the heavy derivative math, we kind of need to ground ourselves in the absolute simplest, most everyday form of market inefficiency.
Think about it like this. Imagine walking into a local thrift store, right? And sitting right there on the shelf is a pair of ultra-rare sneakers for $100. You whip out your phone, check an online marketplace, and boom, buyers are actively bidding $150 for that exact same pair. If you buy them in the store and instantly click sell on your phone, you've just made a clean $50 with basically zero risk. That's spatial arbitrage. And what's wild is that this exact same logic applies to global commodities. Let's say the price of gold in Mumbai is 95,000 rupees, but over in Delhi, that exact same gold is trading for 97,000 rupees.
An arbitrager just buys the gold in Mumbai, simultaneously sells it in Delhi, and instantly locks in a 2,000 rupee profit. Just like that, you've made money with barely any initial investment and zero risk just by spotting that geographic price hiccup. Now, quick caveat, actually an important one. This is a gross profit before transaction costs. We'll definitely circle back to that, but at its core, this is arbitrage in a nutshell.
Moving right along to Section 2, cash, carry, and currency. Okay, let's dive into this because this is where we graduate from simple spatial trades and jump into the deep end with sophisticated derivatives and currency mechanisms. It's kind of like buying a phone at a massive discount today, already knowing you have a guaranteed buyer lined up to pay full price next month. Let's look at index futures, which, by the way, is a huge focus if you're taking the CFA. Say the Nifty 50 spot index, like the price right this second, is 25,000 rupees. Factoring in the cost of carrying that asset over time, the fair theoretical price of a futures contract should be 25,300 rupees. But look at the actual market. The futures contract is trading at 25,700. The market futures are blatantly overpriced compared to the math. Subtract the fair value of 25,300 from that market price of 25,700, and you are staring right at a juicy 400 rupee arbitrage opportunity.
So how do we actually capture that $400? We use an executable strategy called cash and carry arbitrage. Here is the exact playbook. Step 1, borrow some money. Step 2, take that borrowed cash and buy the underlying Nifty 50 index basket. That's your spot asset. Step 3, at the exact same split second, you sell that overpriced futures contract. And step 4, you literally just sit back and wait. At expiration, you deliver the asset you bought into the futures contract you sold, pay back your loan, and pocket the difference. You've locked in that risk-free return, totally immune to whatever chaos the broader market is doing.
And hey, this isn't just a futures thing. The exact same playbook works for currencies. Imagine standing right between two currency exchange booths at an airport, and they've got different rates posted. If the US dollar to Indian rupee rate is 83 in the Mumbai market, but it's sitting at 84 over in the Singapore market, an arbitrager is jumping all over that. You buy USD in Mumbai, instantly sell it in Singapore, and snag a quick 1 rupee profit per dollar. Sounds like pocket change, right? But when you scale this up with institutional money, it is an absolute mountain of cash. Which brings us perfectly to Section 3, the high-frequency giants. Now, you're probably sitting there thinking, well, why isn't everyone just doing this all day? The truth? Identifying these gaps is not really a human game anymore.
Because these opportunities are literally free money. They vanish the exact second they appear. Thanks to the no-arbitrage principle, traders will pounce on these mispricings until the prices balance back out to fair value. To beat the crowd, the absolute heavyweights, we're talking Citadel Securities, Jane Street, Goldman Sachs, BlackRock, JP Morgan, they unleash advanced AI and algorithmic trading. They're constantly scanning global markets for these tiny micro-inefficiencies, executing high-frequency trades in literal milliseconds. Honestly, before you or I can even blink, let alone click a mouse, an algorithm has spotted the gap, bought the underpriced asset, sold the overpriced one, and slammed the door shut.
And this brilliantly illustrates our next point. Section 4, what stops the trade? Let's just pump the brakes for a second and bring this back down to reality. Let's say the algorithms actually miss something, or you're looking at a super complex trade. What actually stops an everyday trader from pulling this off?
As perfect as the math looks on paper, the real world is messy. There's friction. We're talking about 4 main limitations here. First up, transaction costs. Remember that 2,000 rupee profit on the Mumbai Delhi gold trade? Well, if the fees to ship, insure, and execute that trade cost you 2,100 rupees, yep, your profit is completely wiped out. Second is execution risk. Because these prices fluctuate in milliseconds, if your buy order goes through but your sell order lags by just a fraction of a second, the price might gap against you. Suddenly, scratch that, it is absolutely not risk-free anymore. Third, funding constraints. Getting your hands on massive amounts of capital to leverage these tiny margins isn't easy or cheap. And finally, short selling restrictions. A lot of these strategies require you to short sell an asset. If your broker or the regulators say no shorting today, well, you're out of luck. The trade is dead in the water.
All right, let's put you in the hot seat. Section 5, cracking the CFA exam, Level 1, practice. If you're studying for the CFA Level 1, this right here is exactly the kind of scenario they're going to throw at you. Let's look at this setup. Suppose the spot price of an asset is 1,000 rupees. You crunch the numbers and the fair theoretical futures price comes out to 1,060 rupees. But you look at the screen and the actual futures are currently trading at 1,120 rupees. I'll give you a second to think about it. Where exactly is the arbitrage opportunity and what's the payout? Did you catch it? The profit potential is exactly 60 rupees per unit. The actual futures are sitting at 1,120, but the math says they should only be at 1,060. You just subtract that fair price from the actual market price and boom, there is your 60 rupee mispricing.
But hey, knowing the number is only half the battle, right? How do you actually execute the trade? It boils down to a super simple 2-step process you've got to burn into your memory. Step 1, buy the spot asset. Step 2, sell the actual futures. The ultimate golden rule for any CFA candidate looking at these setups is to figure out which side is overpriced and which side is underpriced. You always sell the overpriced side and you buy the underpriced side. Here, the futures were way overpriced, so you sell them.
To wrap this whole thing up, I want to share this perfect one-line summary straight from our source material. Read it with me. Arbitrage is the practice of exploiting price differences between equivalent assets or markets to earn risk-free profit, and it forms the foundation of modern derivative pricing and market efficiency. Literally, without this mechanism, without traders aggressively hunting for these tiny price gaps, the financial models we rely on every single day would just fall apart.
But you know, that really leaves us with one final kind of mind-bending question. If giant financial institutions and AI supercomputers are hunting down every single price discrepancy and fixing them in literal milliseconds, how truly efficient are the markets that you participate in every day? Is there actually any edge left for the everyday retail investor? Are the algorithms already 3 steps ahead before you even unlock your phone to open your brokerage app? Definitely something to chew on the next time you're looking at a stock chart. Thanks so much for hanging out with me on this explainer. Keep asking those big questions, and I'll catch you in the next one.